One question that frequently arises among entrepreneurs when raising money for their business is, how will investors interpret the financial statements that I provide in my business plan? It's a good question and something every entrepreneur should understand when dealing with investors, whether they be angels, venture capital, hedge funds, private investors, or any other source of funds. Let's talk briefly about the balance sheet. The balance sheet is a snapshot, if you will, of your company's financial position at a given point in time. It is expressed in terms of assets, such as cash, receivables, and physical items owned by the company. Liabilities are money owed by the company against those assets, and stockholders' equity, which represents the initial investment by owners and any past profits that have been retained in the business. The balance sheet is aptly named because the assets must equal the sum total of liabilities and stockholders' equity. Said another way, a company's assets less its liabilities is the stockholders' equity in the company. Obviously, this is a very important indicator of a company's overall value to an investor. An investor that is considering funding your company will look at the balance sheet to get an indication of your company's financial strength. The investor will look at assets to see what your company owns. Large amounts of cash and marketable securities, sometimes called liquid assets or current assets, are attractive as they give a positive indication of the ability to meet near-term obligations. Other assets, such as intellectual property and brand names, could also be attractive because the potential to monetize those assets is sometimes substantially more than the value reflected on the balance sheet. Large amounts of goodwill or the amount you may have paid for the company above its book value relative to the total assets could be a red flag due to its intangibility and illiquid nature. A view of your company's liabilities gives an investor a picture of leverage, which is the amount of debt your company is carrying relative to your company's net worth. In other words, if the company were forced to liquidate, could it pay off all of its bills and have something left over for them? A close examination of your company's liabilities will also give the investor an indication of how much cash will be required to meet near-term obligations, and by comparing assets to your company's ability to meet those obligations. In addition to telling a potential investor how much equity the owners have in your company, the stockholders' equity section of your balance sheet will also give an investor insight as to how much money has already been injected into your company, the number of outstanding shares in your company's stock, and your company's use of earnings. The line entitled "Additional Paid-in Capital and Shares Outstanding" plainly tell an investor how much capital has been put into your company and how much stock you had to issue in return for this capital. The retained earning lines will tell an investor how much of the past earnings you have retained in the company. A historical analysis of the retained earnings account will also give an investor hints regarding dividends. If there are entrepreneurs who are putting together their financials for their business plan and have some questions about the balance sheet, they should give us a call at the Capital MatchPoint. We deal with these kind of things a lot, and we've seen a lot of different situations, and at the end of the day, we're here to help.